to this computer. Okay, we are recording, so let me just share the material.
Perfect.
My computer is lagging a lot, so please let me know when you see my presentation in full screen.
Yeah, I can
Is
see
it
it.
yeah, are you seeing it in presentation mode?
No, now it's changing.
Okay, excellent. Now that was just my computer lagging a little bit. Sorry about that.
Okay, okay.
So let's jump into the latest update. If we had had this conversation, I would say a week and a half ago, it would have had a very positive start. I'm still going to have a somewhat positive start to it. After all the challenges we had the last year, there was light at the end of the tunnel, especially with two of the major events that everybody was afraid of: Red Sea continuation of the crisis and a potential strike on the US East Coast. If we look at the Red Sea, the light at the end of the tunnel was that there was a ceasefire agreed between Israel and the Palestinians. And for now, at least when we're talking here on February 13th, that is still holding up. It should be noted that the ceasefire agreement was only a 6 week agreement. And as part of that, the parties need to then agree on stage two and three to get up to a more permanent peace situation. That should be negotiated during the stage one we're in right now. That also means that the carriers have not yet changed their rotation. They are still awaiting. I can kind of understand that because if they do make the decision to send services back through the Red Sea, and if the ceasefire then breaks down, they have to then do a U-turn and go all the way around again. That is highly disruptive. So clearly, the major carriers will only make a decision to go back to a Suez routing when it's clear that we are on a permanent path to peace in Gaza. In terms of timeline, if we were to be extremely optimistic, that decision could be made here during late February if we then get a stage two and three agreed. That is on the positive side. On the US East Coast, the concern was whether there would be a strike between the union and the container terminals. That is not the case. There is an agreement. The only reason I say almost is there's a tiny technicality that over the next couple of weeks, all the members of the union need to also vote whether they agree with the results or not. This is expected to absolutely be a yes. So, good news at the start of 2025 was there was light at the end of the tunnel for the Red Sea crisis, and we averted a major shutdown on the US East Coast. However, then look at the last few weeks. There has now been massive amounts of new uncertainties. If we start with the continuing trade wars started from the US administration, we saw how they announced first 25% tariffs on Canada and Mexico, only to then postpone that the very next day after it was actually implemented. They have already added 10% tariffs. That's 10% on top of anything already applying on China. China has retaliated with some of their own tariffs. Canada has threatened retaliatory tariffs. Whether that will go into effect depends on whether the postponement is then canceled on the US tariffs. We now have, in the last few days, 25% tariffs on steel and aluminum. Trump is exceedingly likely at one point to impose tariffs on the EU. He has been saying that repeatedly. We have no idea how much or when. And in that case, the EU is very likely to basically stand united and also have a retaliation process. And actually, as you and me are talking right now here on February 13th, there's a press meeting announced that Trump will come out and very likely announce what will reciprocal tariffs now be. That is his intent that whatever tariff any foreign country has on the US will mirror that tariff. This all sounds extremely confusing, and it is. From a shipping perspective, this is impossible to plan for or deal with in the current state of affairs. I think the best way to describe this is that no one has the slightest idea what tariffs will and will not be implemented in US over the coming months. Because there's plenty of announcement, then there are retractions, then there are changes. it is impossible for anyone to permanently adjust their supply chains under this current situation. So, from a shipping perspective, we are likely going to see shippers continue to front load cargo as we have for the last couple of months to the degree that's possible. And we are also likely to see all shippers play a wait and see game. Wait until the dust settles, and then we will see more permanent changes to the supply chains. But this is impossible to plan any permanent changes for. From a shipping perspective, again, uncertainty is not good for the supply chain. Uncertainty and unpredictability tends to translate into cost. And with the new US administration in place, there are additional elements that everyone in the shipping and supply chain sector should be aware of because they have the potential of further increasing challenges in the supply chains. There's the US stated ambition of territorial expansion, something that Trump himself was saying during his inaugural address. There are challenges around the Panama Canal, which the US claims they want to retake. The only thing I will add around the Panama Canal is that basically everything the US administration has said about the Panama Canal has been factually wrong. The latest was that US military vessels could suddenly go through free of charge, which was also factually wrong. That doesn't change that the uncertainty around the Panama Canal remains. But the one thing everyone watching shipping should be really concerned about is the new proposal from the Trump administration for a peace in the Middle East, which would involve basically the US taking over ownership of the entire Gaza Strip and moving between 1.5 and 2 million people out. And Trump has said himself that they would never be allowed to go back. At the very best, this proposal will delay the current talks about the ceasefire and the peace agreement. That means that the hope of a resolution to the Red Sea crisis is also postponed. That's the best case scenario. At worst, the US will actually try to implement this plan, try to have US take over Gaza and displace 1.5 million people. This is exceedingly likely to lead to a widening of war and conflict in the Middle East. And in that situation, it's not just the Red Sea crisis. You could very well see hostilities erupt targeted at ships within the Suez Canal itself. So of all the uncertainties that has been launched into the world right now with the Trump administration, the element around Gaza is the one that has the largest potential for disruptions in the short term. If that was to happen, we are not talking about weeks or months more on the closure of the Suez route. We could be talking years of closure. So massive uncertainties, but everyone should plan for major changes, especially when it comes to trade tariffs, trade barriers, and potential sanctions between countries. We take a slightly closer look at the markets as they are currently developing. This is the WCI spot rate developments as a gauge of the market. The one thing to really note is the sharp downturns we are now seeing in spot rates on the major deep sea trades, and especially from Asia to Europe. Seasonally, rates always drop at this point in time. That is after Chinese New Year. That is not unusual. However, the speed with which rates are now declining, and especially from Asia to Europe, that is faster and deeper than what can only be explained by a seasonal effect. So there is a very clear weakness in the Transpac market and an even clearer weakness in the Asia to Europe market, where rates are now going down faster than we would expect. Why is then the key question, is the market extra weak? My interpretation of this is it is actually linked to the transition into the new alliances that was started here on February 1st. That makes it difficult for the carriers to manage capacity when they're phasing in new networks. And more importantly, when the carriers are changing to the new alliance constellations, they will likely be extremely focused on preserving their market shares. That in itself will add to a negative impetus on prices. So the sharp declines right now should be seen as more than seasonal, but likely related to the transition into the new alliances. Demand data, which unfortunately is slightly more lagged than spot rate data, continues to show a very, very strong development. The newest data that came last week is from Container Trade Statistics, and I can see there's a slight glitch here in the bottom of the graph. I'm sorry about that. The blue line, the one called Series 1, that is global TEU miles in the situation where we do not have a Red Sea crisis. The orange one is the situation where we do have the Red Sea crisis. So you can see the difference, but irrespective of which line we look at, demand actually continues to be exceedingly strong. And with the data now being in place for the full year of 2024, we can also look at the annual growth for the full year. And in this case, we also see a very, very strong growth rate in 2024. Of course, in TEU miles, it's fairly extreme. It's 25% up, again, caused entirely by the Red Sea crisis. And if we measure in TEU, we are still seeing a market that is up slightly more than 6% year on year, which for the global container growth is actually very, very high compared to the economic development. The risk when we look slightly more forward is how much of this growth in 2024 has been due to front loading of cargo, especially in North America. Because in North America, there has been multiple elements contributing to front loading of cargo. There was front loading in anticipation of a strike on the US East Coast all the way back in October. Then there was also front loading in anticipation of a strike in January. Then there was front loading because of the Biden administration's tariffs on especially elements related to electric vehicles and solar panels. And then there was front loading in anticipation of Trump's tariffs. So the front loading, it's impossible to quantify exactly how much that accounts for, but if the front loading stops, that's going to have a negative impact on global demand in 2025. Now, what is the underlying baseline? Essentially, this is unchanged because a lot of the developments have been playing out more or less as expected. So we are still fundamentally in a situation where there is significant overcapacity. And if the Red Sea crisis is resolved, the market will indeed collapse relatively quickly. Before I put a few words on how quickly that is, let me just add a few more granular words here on 24 and 25, because this is the model where I try to model global supply demand balance at a monthly level. If the Red Sea crisis continues, we will not see as strong a spike in peak season as in 24. There are more ships that have been delivered. That is going to alleviate the situation. But even when we have the Red Sea crisis continuing, we could indeed see a sharp downturn, which is also what I talked about initially, because of the transition as it goes on amongst the different alliances. But if the Red Sea reopens, there's going to be a lot of turmoil. And I think you have seen this graph before. So I'm going to add a few additional comments to it that we have not touched upon before, because we are indeed going to have major bottleneck problems in Europe. And that, of course, will take several months to clean up. Talks I've had with some of the carriers also imply that they would expect this to last something like 2 to 3 months. Shippers should brace themselves for a period here where we may indeed, especially if you look at spot rate indices, see spot rates decline relatively quickly. But during this transition phase, you will see very significant port congestion charges in Europe itself. And those congestion charges, at least for the transition period, could certainly compensate for the drop in spot rates. It's only after we are through this that we will see spot rates drop in earnest. When we are through this, the market stabilizes. We will indeed see very low spot rates emerge quite quickly. The way to think about this situation is fourth quarter 2023, just before the Red Sea crisis. We had overcapacity globally, substantial overcapacity, to the point where freight rates went back to pre-pandemic levels and the carriers were indeed loss-making. Since then, the global fleet has now grown around 11%, and demand has grown around 6.5%. That means that whatever the overcapacity was in fourth quarter 2023, it is now going to be slightly worse when the Red Sea reopens, and therefore rates are going to continue down quite quickly. My expectation here is especially the mainline operators, they will try to tell the market that rates will not drop that far down because dropping to pre-pandemic levels would be below cost. Cost levels are higher than pre-pandemic. That is factually true. Cost levels are indeed higher than pre-pandemic. But as we saw in fourth quarter, that does not preclude spot rates from actually dropping below break-even levels, and we are likely to see that play out again. Another domino effect here that should be kept in mind, when the Red Sea reopens, we are going to see the supply chain, especially from Asia to Europe, become 10 to 14 days shorter. But from a practical perspective, that means that the European importers will receive 10 to 14 days of warehouses in addition into their current warehouses. This could very likely lead to a temporary and short, but very powerful drop in demand from Asia to Europe as we see an adjustment to this shortening of the supply chain. That in itself would also add fuel to this rapid decline in spot rates, I would anticipate. This could lead to a situation of one, maybe 2 quarters, where the mainline operators become loss-making before they start to pull capacity out of the market to then rebalance and rates would start to come up. There are indeed arguments in the market that scrapping will take care of part of this. There has virtually been no vessel scrapping for 5 years. That is true. And that also means we could likely see a scrapping of as much as 6 to 8% of global capacity. But this effect is not going to be immediate. When the Red Sea reopens and rates begin to plummet after the initial turmoil, a lot of these old ships will still be operating on time charter deals lasting 3, 6, or 12 months. So whatever scrapping we are going to see, and we will see significant scrapping, that will happen with a lag time of likely 6 to 12 months after the market collapse has begun. So scrapping will not prevent the immediate market collapse once the Red Sea reopens, but will serve to then rebalance the market after 1 or 2 quarters of losses. So we already talked about the new alliances. Let me not add a lot more to that. The only thing to note, of course, is the very, very different network design that is being launched into the market. At one extreme, with MSC trying to do as many direct port pairs as possible, whereas Gemini with Maersk and Hapag-Lloyd is going all out on a dedicated hub and spoke network with very few but very large hubs, and then dedicated shuttles instead of feeders. Which one will be commercially more attractive? I don't think this is a winner take all. There will be customers for both markets, but all shippers, of course, need to sit down then and do their own homework in terms of which of these products are most suited for my needs. One thing, of course, that has taken a lot of headline is the promise by Gemini to reach 90% reliability. And I know a lot of shippers don't believe this is possible. I can understand that. The last 5 years has been horrible in terms of reliability. Global reliability in 2024, on average, was around 52%. So 90% sounds ridiculous. But think back when the markets were normal in 2019 or before that. If we look at the most reliable alliance at that point in time, it was actually 2M. And if we look at some of the major deep sea trades, you will see that prior to the pandemic, 2M actually did operate at more than 90% reliability on the Asia-Europe trades. They didn't on the Pacific, but they did on Asia-Europe. That in itself tells us this is actually possible if the two carriers prioritize it. Don't expect 90% reliability now or in March or in April. This is going to take time to be phased in. I would assume that we will see that level of reliability once we get to third or fourth quarter 2025. And a few other major issues to keep in mind here for 25 and potentially into 26. As I already mentioned in the beginning, this cannot be understated in terms of risks. If Trump goes ahead with his plan for Gaza, that has a potential of catastrophically worsening the Red Sea crisis and basically shutting down that line for years, not for months going forward. We should expect extreme price swings. As we have seen in the last 5 years, whenever there's insufficient capacity, rates skyrocket. But the moment there's overcapacity, they drop rapidly and fast. That is what we should continue to see here in 25 and 26. Anyone that ships to and from Europe will, of course, have noted that the carbon taxation, the EU ETS, on shipping has increased here in 25. That's part of the ramp up. There has also been an additional new legislation called Fuel EU that also adds fuel surcharges to any shipments to and from the EU, as the shipping lines have to use a certain element of biofuel. This is going to increase further in 26 because the EU ETS was only 40% phased in 2024. It is 70% phased in now in 2025, and it will be 100% phased in 2026. Going beyond 2026, we will see whether at the IMO level they agree on a global carbon taxation. That may or may not happen. They have two meetings here in 2025 where the intention is to potentially agree on this. If that happens, we'll see carbon taxation surcharges on all trades. If it doesn't happen, you should at least prepare for the EU to increase their own carbon taxation on shipping from 2027. And on top of that, we simply have unpredictable geopolitical risks. We've had a new US administration for less than a month, and we already have all the tariff issues I mentioned. We already now have geopolitical turmoil with the US in Panama, in Greenland, in Canada, in Taiwan, and in Gaza. That's just within 3 to 4 weeks. So there is significant geopolitical risk to all supply chains. There's no way of predicting how this falls out. So for all stakeholders in the shipping sector, it's about staying close to developments and being very, very flexible and nimble in dealing with whatever changes suddenly pops up. Then I want to add a few words on some major topics that are also relevant and will continue to shape the markets in the coming years. The first one is on decarbonization. It is difficult to see the industry, and here's the shipping industry overall, not just container ships, reach the targets that have been placed for 2030, 2040, and 2050. First of all, because the green fuel that is needed is not really being produced, or the production of it is not being ramped up at the pace that was anticipated. So even for shipping lines that do want to use green fuel, physically getting the fuel is difficult. Adding to that, we have a market environment, and that goes for container shipping as well, where there is a very high unwillingness amongst the shippers to actually pay for this. So meeting the targets that are out there is highly questionable. As I mentioned before, there is a push in the IMO to implement basically a global carbon tax on fossil fuels in the maritime sector. If that is done, it will be at the MEPC meetings on IMO, either in April or October 2025. Personally, I find it somewhat difficult to see a full-on global solution. It's certainly not possible to see a Trump administration agreeing to anything like that. But mind you, an agreement could be made also without the US. It would just mean that enforcement of that agreement will be spotty and open a lot of loopholes for exploitation going forward. The geopolitical impact, we already covered quite a bit of this. Let me just add another word on this, especially if we look at, for example, the tariffs that he's coming up with. The learning point from the first Trump administration, and when he started the price war with China, is that this is actually very, very simple. If he adds trade barriers to a specific country, goods will flow in another direction. When he raised tariffs on China, some of the Chinese goods were instead shipped to Mexico. In Mexico, they were slightly reprocessed, then they're Mexican goods, and then they make it into the US. That's the key for why Mexico to US trade has been booming. So if he indeed does introduce this significant trade tariff of 25% on Mexico, a lot of these goods that actually originate in China will just find another way to flow into the US. This could be via other countries in Central America or Caribbean, or other countries in Asia. So as long as all of these trade tariffs are completely unpredictable and coming and going on a day-to-day basis, nobody are changing their supply chains. Once the new landscape of tariffs solidify and we know what it is, all the shippers out there will simply find out what is then the second cheapest option for routing the cargo. That can cause quite some shifts in terms of which trades are and are not being used. And in a short term, that could actually create bottlenecks in some shipping services if everybody suddenly decides to change to use the same ports. And don't think it ends here. What I see here, I mean, now we talked a lot about Trump, but he's not the only one. We've seen a geopolitical reality emerge over at least the last 5 years that is more and more focused on nationalism, focused on making decisions that seems to bolster the individual country. That means that the decades we had of globalization, more free trade across the world, is right now going in the opposite direction. We're seeing a regionalization with more trade barriers. This is not only in relation to the US. So if we look over the next 5 to 10 years, all shippers should begin to already now brace themselves for more trade wars, not just including the US, but also other countries, more sanctions, and more difficulties in the supply chain. That basically covers all I have already mentioned. So let me finish on this one. Whatever you do, don't assume that the market environment will become stable and normal. It never has been, but especially the geopolitical turmoil is going to cause more major unexpected upheavals that we can't even predict right now. So it's about being flexible, about being able to shift sourcing patterns, shift supply chain providers, shift which way you route the cargo, do that relatively quickly. Nobody wants really to pay for resilience when there's overcapacity. So that's why we get some of these extremely wild swings. So when we do get overcapacity, say the Red Sea does reopen and we get through the turmoil in Europe, we'll get to loss-making rates. But if we get a geopolitical event somewhere that soaks up capacity, rates can skyrocket again from one week to the next, just as we have seen in the past. So even though I would have loved to start up only with the positive news that we avoided the strike on the US East Coast, there was light at the end of the tunnel of the Red Sea, the chaos in geopolitics and tariff policies over the last few weeks does not tell us that we're going to have a smooth ride here in 2025. That was the market overview as I had prepared it here. Do you have any questions related to it before I stop the recording? There are two different impacts of the tariffs. One impact is when it's being redirected. From a carrier perspective, I can understand why they say that's not going to make a major deal. And if we look at the first Trump administration, when he started the trade war with China, we saw a huge drop in goods from China to US, but a large increase then in goods from Southeast Asia to US and China to Mexico. So from a carrier perspective, it's still the same goods being shipped across the Pacific. It's just being shipped between different ports. So in that respect, I can understand why the carriers say tariffs are not going to have a major impact. The goods are still going to flow. But there's another impact that could be much, much worse. This is an if, because we don't know how the eventual tariff landscape will look. But if the US introduces a huge array of major tariffs, that is going to lead to an increase in inflation in the US. So goods will become more expensive. And then the question is, how will the US consumer react? They are already very, very annoyed at high prices. If prices go even further because of the tariffs, you could be in a situation where, say, over peak season or Q3 or Q4 this year, the US consumer says this enough is enough, that they're going to cut back on spending. If the US consumer cuts back on spending, here's the problem. You're going to have very high inventories because everyone has been front loading cargo. And if the consumers at the same time stop spending, then they're going to be stuck with high inventories that are not moving. The US importers will then stop ordering goods and you'll see a collapse in containerized demand. Yeah, exactly. I mean, what everybody will look for, goods always follow the cheapest path. And when I say cheapest, it's the combination of what is the actual production cost and what's the transportation cost. And they always follow the cheapest one. So again, as a simple example, it used to be cheapest to make in China and ship to the US. Then tariffs were introduced. So that was no longer the cheapest. Then the cheapest was to produce it in China, ship it to Mexico, slap a Mexican label on. Then that's what was happening. If that is no longer the cheapest one, the importers will then look for what is the next option and the next and the next. The one thing I don't think is going to happen is a major shift of manufacturing back to the US for a
Okay.
couple of reasons. One, again, is pure cost. If you are a major US importer selling goods in the US and you're currently not producing in the US, that means you need to build a new manufacturing unit in the US. That takes a long time. It's a major investment, and you're likely going to be tied down with that for the next 10 to 15 years. Do you want to be tied down in a financial decision for 10 to 15 years for a problem that might only last 4 years until they get a new president? For a lot of companies, that's a no-brainer. Then it's easier to deal with the problems over the next 4 years than it is to actually build a manufacturing unit in the US. And so they would just be looking for what's then the cheapest way to route around. Secondly, if there was actually a genuine desire to ramp up manufacturing dramatically in the US, somebody would need to answer the question, where are they going to get their labor force from? You've got record high employment in the US. At the same time, they're in the process of now deporting millions of illegal workers that are going to be sorely missed in the agricultural industry. So with the current policies being implemented, US is going to have a shortage of a labor force, which again means nobody's going to nearshore manufacturing to the US. For Latin America, though, I don't see why there should be a shortage of containers for Latin America. Latin America will be impacted by a significant overcapacity of ships. There will be a short-term impact on Latin America, especially in the trade between Europe and Latin America. Because when the
Okay,
Red
okay,
Sea
okay.
opens up, you see this massive port congestion in Europe. Because it's port congestion, it's going to impact all services, including the Latin America to Europe services. So they are going to be indirectly impacted for a few months as well. That is a good question, and I must admit I don't have a good answer to that one. I simply don't. I would say the freight forwarders, for them, this enormous geopolitical instability I'm talking about is actually an advantage because it's going to create an environment where a lot of cargo owners might be forced to change their supply chains very, very rapidly, which usually is easier to do if they tend to work through a freight forwarder than if they're locked in with just a few specific carriers. It gives them more flexibility and more options. So I would say the turmoil in the both in the trade wars and also on the geopolitical side is actually an advantage for the freight forwarders out in the market in the coming years. Only explanation I can come up with is that they are trying to increase basically their scale advantage, if you can even talk about there is a major element of scale advantage. It's kind of the only reason I can see out there. I mean, keep in mind the freight forwarder market from also a global perspective is still enormously fragmented, and therefore there is scope for more consolidation. So likely it should be seen in that context. Think it's again part of an overall strategy. I think Costco wants to have a much stronger foothold everywhere in the world, including down on the west coast of South America. And this is a stepping stone for them to get it. They want to have control to a larger degree over their supply chain.